Section 6. Choosing the right loan, understanding the buyer's financing options. Ashley finally gets the call she has been waiting for. Rachel has reviewed her initial financial information. Daniel has explained the basic mortgage process, and Ashley is ready to start looking at homes. Before Daniel schedules the first showing, however, Rachel says something Ashley wasn't expecting. We should talk about which loan program makes the most sense for you. Ashley looks confused. I thought a mortgage was a mortgage. I borrow the money, buy the house, and make payments. Daniel smiles, because this is another moment when a first-time buyer discovers that the home buying process has more moving parts than expected. Not every mortgage is the same, and the financing a buyer uses can affect more than the monthly payment. It may influence down payment requirements, mortgage insurance, property eligibility, appraisal requirements, seller negotiations, closing costs, and sometimes even which properties make sense for the buyer to pursue. Rachel explains that buyers may encounter several common loan programs, including conventional, FHA, VA, and USDA financing, depending on their eligibility and circumstances. Daniel understands the basic differences because they affect real estate transactions, but he remembers Michael's rule: know enough about lending to recognize the issue, but don't become the loan officer. Rachel is responsible for helping Ashley evaluate interest rates, qualification standards, down payment requirements, mortgage insurance, lender overlays, and which program may fit her financial circumstances. Daniel's role is to understand how the selected financing may interact with the property and purchase contract. Let's start with conventional financing. Conventional loans are generally not insured or guaranteed by a federal government housing program in the same way as FHA, VA, or USDA loans. Depending on the program, borrower, down payment, and other factors, conventional financing may offer different options regarding mortgage insurance and property requirements. But here's where agents need to be careful. You may have heard someone say, conventional always requires 20% down. That's not accurate as a universal rule. Conventional loan programs can permit lower down payments depending on the program and borrower qualifications. The lesson for the agent is simple. Don't turn a general rule of thumb into a lending requirement. Rachel also discusses FHA financing, which involves mortgage insurance through the Federal Housing Administration. FHA financing can provide opportunities for qualified buyers who may benefit from its particular underwriting and down payment structure. From Daniel's perspective, another important consideration is the property. FHA appraisal requirements include attention to whether the property satisfies applicable minimum property standards and requirements. That does not mean an FHA appraisal is a substitute for a professional home inspection. Those are different functions, and we're going to spend considerable time discussing that distinction later in the course. Then, Rachel asks Ashley a question Daniel didn't know to ask. Have you ever served in the military? Ashley says no, but the question gives Daniel an opportunity to explain VA financing. Eligible veterans, active duty service members, and certain surviving spouses may have access to VA home loan benefits. VA financing can offer significant advantages to eligible borrowers, including programs that may permit financing without a traditional down payment, subject to VA and lender requirements. VA loans also have their own appraisal and property requirements. Again, Daniel doesn't determine eligibility. He recognizes the program and allows the qualified lender and appropriate VA resources to address the details. Rachel also mentions USDA financing. Ashley laughs and says, I'm not buying a farm. This is a common misconception. USDA housing programs aren't simply agricultural loans for farmers. Certain USDA rural development programs can provide home financing opportunities for eligible borrowers purchasing eligible properties in qualifying areas. Geographic and income requirements can apply, which means the buyer and property both matter. In Arizona, that can become relevant when clients are looking outside the most densely populated metropolitan areas. Daniel should never assume a property qualifies simply because it looks rural. Eligibility should be verified through appropriate USDA and lender resources. Here's where the lesson becomes practical for the real estate agent. Imagine Daniel shows Ashley a property she absolutely loves. They prepare an offer, negotiate for 2 days, and finally reach an agreement. Only afterward does Daniel realize that a feature of the property may create a problem for Ashley's particular financing. Now everyone is scrambling. The buyer is emotionally invested, the seller thinks the transaction is moving forward, and the lender is raising questions that could have been identified earlier. This is why experienced buyer's agents ask about financing before property selection becomes serious. The financing type can also affect how an offer is written. Arizona purchase transactions may involve financing-specific provisions or addenda, depending on the loan program. Agents need to use the appropriate forms, understand the contractual implications, and coordinate with the lender when information is needed. Guessing at loan terms when preparing an offer is not a good practice. Ashley then asks, "Which loan is the best one?" Daniel responds, "The best loan is the one you and your qualified lender determine appropriately fits your circumstances. My job is to understand how that financing affects the real estate transaction. That's an important professional boundary." Daniel can discuss how a financing structure might affect negotiations or property selection, but he shouldn't choose Ashley's mortgage product for her. Fair housing and fair lending considerations also remain in the background of this conversation. Daniel should never assume a buyer belongs in a particular financing program based on race, national origin, familial status, disability, or another protected characteristic. Nor should an agent discourage a qualified buyer simply because the agent or seller views one lawful financing method as less desirable, without understanding the actual terms of the offer. Each transaction should be evaluated based on legitimate financial and contractual considerations. After discussing the options with Rachel, Ashley has a much clearer understanding of her financing strategy. Daniel now knows what financing she expects to use. Rachel knows what documentation she needs, and everyone has a better idea of the properties Ashley should consider. Ashley picks up her phone and says, "Okay, Daniel, now can we finally look at houses?" Daniel laughs. "Yes, now we're actually ready." In the next section, we're going to join Ashley and Daniel in the car and begin the property selection process. Because finding a house isn't simply about whether Ashley likes the kitchen. The type, condition, ownership, location, restrictions, disclosures, and history of a property can dramatically change the buyer's journey. Online discussion 1. Ashley asks Daniel whether she should choose conventional or FHA financing. How should Daniel handle the question? Answer. Daniel can explain general real estate considerations associated with different financing types, but he should not act as Ashley's mortgage professional. He should encourage Ashley to evaluate specific qualification requirements, loan costs, interest rates, mortgage insurance, and financial suitability with Rachel or another qualified lender. Daniel can then help Ashley understand how the selected financing may affect property selection and the purchase contract. 2. Why should Daniel understand Ashley's expected financing before seriously selecting properties? Answer. The financing program may affect property eligibility, appraisal requirements, contractual documentation, closing costs, and other aspects of the transaction. Understanding the expected financing allows Daniel to identify questions earlier and coordinate with the lender before Ashley becomes emotionally committed to a property that may present financing complications. 3. Ashley assumes USDA financing is only available for farms. What should Daniel explain? Answer. Daniel can explain that USDA rural development housing programs may be available for qualifying residential properties and eligible borrowers, and are not limited simply to working farms. Geographic, income, property, lender, and program requirements may apply, so eligibility should be verified through the lender and appropriate USDA resources, rather than assumed by the real estate agent.